I'm Owen Bigland. This is the Inside Edge video blog. Okay, let's talk about interest rates here. It's on top of mind for everyone. When are interest rates finally going to start coming down? You read these reports out endlessly. I have anyways. I've been talking to you guys about some of the Canadian economists that have been saying that interest rates are too high and the Bank of Canada has to wake up here and start reducing rates sooner rather than later. And it's pretty funny. I don't know what the story with the Bank of Canada is. I mean, we live in a very conservative country here, of course. I've talked about it before. Don't want to give anyone too many clues as to where things are going as far as interest rates. After all, they really hoodwinked, is what I would call it, a lot of Canadians, including myself, back during COVID, where we were shutting down the economy. Interest rates were at record lows. Bank of Canada at that time came out and said, hey, don't worry. We're going to keep interest rates low for a long period of time, let the economy recover with COVID and all that good stuff. Interest rates at that point, variable, I think got all the way down to about 1.2 or 1.3%. And to go ahead and buy that house, put money into the economy, let's keep the economy going, buy that $2 million house, lock in a 5-year variable at 1.2, 1.3%, and you're golden. And then I got caught on it too. I had two. Luckily, they were not large mortgages and they were both on investment properties. I renewed two at 3 and 4 year variables at incredibly low rates and thought this is great. Not 6 months later, the Bank of Canada completely did a 180 reverse course and started the first of 11 interest rate hikes, unprecedented. Took the variable rate from 1.2, 1.3 up to its current about 6.7%. And I'm in it myself. Now again, it's not affected me too much. Small mortgages, and it's all deductible because they're on investment properties. So we got fooled once. I get it. The Bank of Canada now, I think for the 4th straight meeting, has paused on interest rate hikes. Yet they still have not officially announced they're paused, which is kind of crazy. And of course, they don't give you any guidance. They don't want to give you any incentives or any optimistic outlook saying maybe later this year, sometime in the summer, perhaps we might even reduce rates. But of course, a lot of people are reading the tea leaves here, a lot of economists. I talk about Canada's top economist, David Rosenberg, who's been on BNN all the time. He's on there saying, and I've done blogs on it, saying that we've over-tightened here and that even the rates hikes that we were doing last year still haven't fully trickled into the economy. But I've seen now reports from BMO, National Bank, Royal Bank, this one I'm going to tell you about with TD Bank that have come out, wondering what's going on here with interest rates. As a matter of fact, our inflation rate is back down to 2% once you back out housing costs, mortgage costs, and rental costs. So this is from today's Wall Street Journal. It's funny, I kind of tend to get a lot of my best news on the Canadian economy and interest rates from U.S. publications. The Wall Street Journal does a weekly newsletter that covers Canada in pretty good detail. The economy, jobs, interest rates, housing market, all that good stuff. But this is in today's Wall Street Journal, and they cite a report here that just came out 2 days ago from the chief economist at TD Bank. So here's what it says. TD Bank economist team warns the Bank of Canada risks causing undue economic harm unless central bank officials are prepared to put less weight on shelter costs when judging inflation. Shelter costs, which rose 6.2% in January from a year ago, have accounted for half of Canada's total inflation rate. TD Bank estimates that Canada inflation, when calculated like the Federal Reserve's preferred core PCE gauge, so down in the States they use what's called core inflation, which backs out housing. In Canada, if they did that, we would be at 2.1%. So we would be back to where we wanted to be at that 2% inflation rate, where we wanted to tamp inflation down to. We're already there, and it's still going down. Unless the Bank of Canada cuts by over 3 percentage points this year, 3 percentage points, this is going to lead to a deep recession in Canada. So they're calling for 300 basis points or 3 full percent. Furthermore, TD calculates that rent inflation shows no sign of ebbing, giving the huge undersupply of housing units. Shelter inflation isn't going away no matter how quickly they decide to cut rates. Pretty powerful stuff here, and this isn't the only guy. I saw a similar report to this done a couple weeks ago by RBC, National Bank, and BMO have all come out with similar reports. So we're at 2.1% if we used, like they do in the States, that core inflation, which backs out housing shelter costs. That's what's causing our inflation, is the 6.7% variable interest rates, which of course, when it comes to rentals, of course, as I've talked a lot of times before, gets passed on to the tenant in the form of higher rents. So they're calling for Bank of Canada to reduce 300 basis points this year. As far as I know, I think Rosenberg there is still calling for 2 full percentage points this year and another 1.5 or 2% next year. So, we very well might see the similar situation here where in the reverse, back 3 years ago, hey, don't worry about it, lock in a variable, interest rates aren't going anywhere, and then they give us 11 hikes. We very well might see the same thing here, where out of nowhere, all of a sudden they start cutting 50 basis points month after month. And we knock this variable rate down from 6.5 to 3.5 in the next 12 months. Who knows? I think if people were going to, and I'm talking to my mortgage specialist, I think if your mortgage is coming up for renewal here in the next few months, 6 months, whatever, this year, I would probably, they're telling me, just go with a variable rate. Lock in a 1-year variable, plug your nose right now at 6.5 or 6.6 or 6.7. But that'll probably get you the best rate, because don't be surprised if these rates start coming down pretty precipitously over the next 6 to 12 to 18 months here. We'll see. But, interest rates, I've said all along here, and now, of course, people will criticize me because, oh yeah, Bigland, you're a realtor, and of course you want to see lower interest rates. You also own a large investment portfolio. Yes, I do. Interest rates, these higher interest rates really haven't affected me all that much because luckily I've been in fixed term rates a lot, and some of them I locked in at incredible rates during COVID time there, locked in 4 and 5 year mortgages. But I do have 2 variables that went from 1.2, 1.3 up to 6.6 or 6.5. But we should be reducing rates here, pretty soon. Now, I think, again, if you're looking to renew a mortgage here, I would probably just stick with variable for right now. I don't think I'd lock in anything more than a year if you wanted to, because I do think rates are going to start coming down. But again, this is they're screaming from the rooftops here. We'll see what the Bank of Canada does here moving forward at their next meeting. Again, they haven't even announced that they've officially paused. But I think in the States, of course, less so in Canada. Last fall, you started seeing investors in the stock market, anyway, starting to read the tea leaves a little bit and buying equities, getting out of fixed income stuff and buying equities. And it's paid off incredibly well for them since last fall. Canada to some extent too. I think in the housing market, I saw some of that in November and December. Buyers getting out there, buying, thinking, hey, we'll lock in a 1-year rate or just go on a variable for now. And by this time next year, we'll probably have a much better rate. And I think they're going to be right. As we speak right now, we're into late February, early March. Market is okay. It's hanging in there. There is just not a lot of inventory. And that's what's really keeping this market down. But I can tell you, when the Bank of Canada finally does announce, give these guys the green light that we've paused, and when we get those first few interest rate drops, watch out. This market is really going to pick up. The problem is, though, I don't think inventory is going to keep up, and we're going to start to see prices rise. So if my last message to you is, if you're in the housing market right now, you're pre-approved, you're looking for homes, the biggest problem you have is you can't find anything. But I would stay the course. Hopefully you'll find a house that you like. You can buy it at a good price. Buy it, keep it, enjoy it. Because I think as interest rates start coming down, it's going to definitely put upward pressure on prices as we move forward. But finally, interest rates are too high. They've been too high for too long. I know, sound like a typical realtor and investor. We haven't even felt the interest rate hikes from last summer take effect yet here. It takes about 18 months for these to trickle through the economy. According to TD right now, our true inflation rate is at 2.1% and still dropping. 2.1%, so that's our target rate now. Once you back out the cost of housing, mortgage costs, rental costs. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.